Chapter 11, Part 4, we're going to look at intangible assets, natural resources, and group depreciation. So, intangible assets with estimated useful life are amortized over their service life. Intangible assets with indefinite life we have to do an impairment test annually or more if needed. So, useful life. Legal, regulatory, or contractual provisions often limit the useful life of an intangible asset. The useful life might sometimes be less than the asset's legal or contractual life. And residual value is expected residual value of an intangible asset. Normally we use 0 because we probably won't sell it when we're done with it. Be like a logo or a patent. The residual value is not 0 if at the end of the asset's useful life to the reporting entity, the asset will benefit another entity. Allocation. The method of amortization should reflect the pattern of use of the asset in generating benefits. Now, how do we value them? Well, under GAAP, we cannot revalue an intangible asset, but under the international standard, they allow an intangible asset to be subsequently revalued if fair value can be determined by reference to an active market. However, goodwill cannot be revalued, but an intangible asset can. So let's take a look at an example under both methods. So we purchased a patent for $500,000, had a life of 12 years, but the company said they're only going to use it for 10. And on January 1st of 2027, 2 years later, they spent $40,000 successfully defending the patent, and they estimated the total service life of the patent is now just 7 years. The end of 2027, the patent has a fair value of $400,000. So let's take a look at what this looks like under GAAP. So the annual amortization is $50,000. And you notice we don't have a contra account. We directly reduce the intangible asset. There is no contra account. Now, what is the journal entry for the legal fees? It would be patent, cash. Now, what about our amortization? So the cost would have been $500,000. We've been depreciating it for 2 years. We added the legal fees. Now we have a new depreciable base of $440,000, and we have 5 years left. So now we're going to amortize at $88,000 a year. So what would our journal entry look like? Do we have to make any adjustments, prior period adjustments? The answer is no, because even though it now has a fair value of $400,000, we cannot write up our asset. So let's take a look at it under the international standard. We had a book value of $440,000. We had amortization of $88,000. So now we have a book value at the end of 2020 of $352,000. The fair value is $400,000. So we can write it up under the international standard. So we would write up our patent by 48, and we'd have revaluation surplus, which would go to other comprehensive income. Now, what about natural resources? Well, normally we use units of activity. Now, the reason we do that is because the usefulness of a natural resource is directly related to the amount of resources extracted. Service life is the estimated amount of natural resources that you can get out. Fixtures or equipment associated with the natural resource that cannot be moved are allocated based on service life of the asset or service life of the natural resource, whichever is shorter. Depletion of natural resources and depreciation of assets used in the extraction of natural resources are part of product cost and therefore included in cost of goods sold, and stay in inventory until the units are sold. So let's take a look at an example. Okay, we bought a piece of land for $606,300,000. We also bought equipment for $180,000 with a service life of 6 years. The company expects to extract 900,000 tons of ore over 4 years, and during 2025, they extracted 240,000. So what's going to be our depletion? Well, we're going to take our cost divided by 900,000 times $7 gives you, we're going to have depletion of 1,680,000. And for the equipment, we're going to have to use the tons because it's 4 years, which is less than the 6-year service life. So we're going to have depreciation of 48,000, and that would be our depreciation for the year. The total would be 48, and depletion would be 1,680,000. Now we're going to look at group depreciation. Now, a group depreciation. Group and composite depreciation methods depreciate assets collectively rather than individually, but they have to be alike. So, you collection of depreciable assets that are similar service lives and other attributes like cars or trucks or computers. It's a collection of depreciable assets that are physically composite. Oh, group depreciation is they're the same. Composite is they're physically dissimilar but are aggregated anyway to gain the convenience of a collective depreciation calculation. So those are the two, but we're going to look at group depreciation where the same. Now, possibility of change in constitution of the asset group as new assets are added and others are retired. These are things you have to take into account. Additions are recorded by increasing the group asset account by the cost of the addition, and depreciation is determined by multiplying the group rate by the total cost of assets in the group for that period. Group and composite depreciation. After the group or composite rate and the average service life are determined, they normally are continued despite any additions or dispositions of individual assets. No gain or loss is recorded when a group or composite asset is retired or sold. Any actual gain or loss is included in the accumulated depreciation account. So let's take a look at an example. We have a bunch of vehicles. We know that we spent $385,000 in total. We have a depreciable base of 343. They all have different service lives, but we have an annual depreciation based on their service lives of 65,000. What is the group rate? We're going to take the annual depreciation of 65,000 and divide by the total cost, and it tells them we're going to depreciate at a rate of 16.9%. What is our average life? We're going to take the 343 to depreciable base divided by the annual depreciation. So we know that the average life is 5.28 years. Now, what happens if we buy and sell vehicles? So in this case, we replaced 2 trucks and bought another truck. We received $20,000. So we bought 2 trucks at $20,000 each. We sold our 2 old trucks at $6,000 each with original cost of $15,000 each. So how do you record the purchase? It would go trucks, cash. To record the sale of the old, we'd go cash 2 times 6, which would be $12,000. The book value, what we paid for them, would be 2 times 15. And the plug would be accumulated depreciation. Now, what would be our depreciation for the year? We would take the total cost times the depreciation rate. So we would take our 385 minus the cost of the trucks that we sold plus the cost of the new truck times our depreciation rate gives us our 66,755. And that concludes this presentation.